Let us now understand the safest way of entering the stock market for an individual with little knowledge. The safest way to enter the stock market is investing through mutual fund. Now the doubt arises is, what is this mutual fund? I believe most of you would have heard of this but may not have clarity what exactly this is. So mutual fund is a type of investment wherein they pull money from lot of people and invest it in various market instruments such as stocks, bonds, etc. The goal of mutual fund is to generate higher returns compared to FDs in the longer run and for longer time of period. The growth of mutual fund in India can be understood by the fact that the value of mutual fund in India as of June 2024 is rupees 61 trillion, which has grown by sixfold in past 10 years. Friends, now we will understand all about mutual fund. We have been seeing lot of advertisement on TV telling mutual fund sahi hai, ye hai, wo hai. Now we will understand whether it is really good for a retail investor or again it is all gimmick of an advertisement. I would say that mutual fund over a longer period of time is really beneficial, especially for the current generation. Now, why am I saying this? Especially in India, let it be any type of expense, education expense or housing expense or medical expense is continuously increasing. Now, how do we reach our goal with limited income which most of us have? One option is that we become very good in stock market and directly invest in equity, or become the best in stock market and earn lot of money through derivatives. But as we all already know, 90% people lose money in the derivatives and 50% people lose money in the equity segment. So the only viable option left for us is to invest through mutual funds. Now, what exactly is this mutual fund? Basically, what happens in mutual fund is that the AMC. Now, what is AMC? Asset Management Company. The company which manages mutual fund is known as AMC. What AMC does is, it pulls monies from lot of investors and buys lot number of stocks. Obviously, when we are buying many number of stocks, on the downside it is that if we have bought one or two stocks, if that stock should have grown, we would have bought lot of money. But on the upper side, which is having a very positive impact for us, is that if we buy 20 stocks and out of that if 15 performs well and 5 does not perform well, overall we will be in the positive. That is what is happening in mutual fund. So AMC is pulling in money from lot of investors and putting it in various companies and hoping to generate interest above FD. In fact, the goal is to generate interest around 15 to 18% over a period of say 15 to 20 years. And an amount as low as 15,000 per month over 15 to 20 years, providing a compound interest of 15 to 18% can help us generate a lot of wealth. You will be surprised to know that there are around 2,000 mutual funds being offered for an investor to invest in. In this topic, from now onwards, we will understand what category of mutual funds our investors should opt. The goal, again, as I said you here, is to try to generate return above FD. Overall, the whole mutual fund investing can be divided into 4 types. These are equity funds, debt funds, hybrid funds, and money market funds. As the name suggests, equity funds invest directly into the stocks, and equity funds can said to be riskier than all other 3 types of funds. Coming to debt funds invest in fixed instruments like bonds, government securities, etc. Here generally the rate of return is low compared to the equity fund, sometimes as low as half, but it is generally more than FD, and you are sure about your capital protection as well as appreciation on the capital. Now, suppose an investor who wants to have best of both the worlds. So what he can do? He can go for hybrid fund. So hybrid fund, what they do is they invest certain portion into equities and certain portion into debt funds. So here what happens is, if the equity performs well, he can generate a return greater than the debt funds. And if, let's say, equity does not perform well, his debt portion will make sure that his capital is protected, and in most cases over a period of, let's say, 3 to 5 years, he will have a positive return higher than FD. Under the main categorization, the last fund is of money market funds. So money market fund is an open fund. It is a short-term debt fund which invests in treasury bills, commercial papers, or certificate of deposit. So it is like a debt fund, but for even shorter period. After having understood the main important type of funds, now let us see, suppose an investor wants to invest in any of this fund, how does he do that? So there are 2 to 3 ways of doing it. One is directly going to the AMC website and buying it, which is cumbersome. Basically, every AMC, asset management company, will have its website. You can go there and you can directly buy it. But it is very cumbersome because, let's say, you want to invest in 5 different mutual funds, then you'll have to go to 5 different AMC website and you'll have to invest from there. Second option to buy a mutual fund is through stockbrokers. So herein the investor will need to open an account with the stockbroker. Advantage here is that he can buy any mutual fund directly from the stockbroker. Depending on the stockbroker, there may or may not be charges charged by the stockbroker. Now we will understand how we can purchase a mutual fund. So when we purchase a mutual fund, we purchase it in terms of number of units of NAV. So NAV here is net asset value. So basically we purchase, let's say, 10 units of NAV or 100 units of NAV. Let's try to understand a bit of NAV. So as you know, mutual fund investment is nothing but money poured by number of investors. So to reach NAV value, what the AMC does is, or what the formula says, NAV is all the money poured minus any expenses divided by the total number of shares. Suppose, let's say, today NAV is 11 rupees per unit and you buy 100 units of NAV. If the value of NAV goes up but tomorrow, then the same NAV will be at 11.2 or 11.3 tomorrow.